for joining us this evening, wherever you may be in the world. We've got a lot to get through. We're absolutely thrilled to have David with us tonight, but I'll share a little bit more about David and his areas of expertise. We've got a few specific areas to focus on, largely around tax planning, mobility, and all things UK, Australia, and Singapore. So should be a great session. We've got both the chat and Q&A box or panels being monitored. So if you have any questions as we go through, please do feel free to pop your question down. We'll try and keep most of them to the end, just so that we can make sure that, well, particularly David has a chance to get through all of the information that he has for us this evening, and just to make sure that everyone gets a lot out of tonight. But certainly there'll be time for questions. But yes, as I said, thank you very much for joining us. My name is Jared. I'm a financial planner here in Singapore with Global Financial Consultants. Been here for about 8 years in Singapore, and like everyone, living the dream at the moment on this little red dot. But on to why we're all here this evening. So before we get into tonight, just a little bit of a general disclaimer. We are not tax accountants. Everything you hear on this session today, this evening, is general information only. It is not financial advice. If you want personal financial advice, reach out to your advisor, reach out to our team at GFC if you don't already have an advisor, and we'd be more than happy to assist. So tonight is all about entertainment and information. A little bit about of background on GFC and the company. Originally started in Sydney, which is quite nice for me being Australian, even though I am from Perth, but been up here in Singapore for quite some time now. We have a great team of diverse advisors working with people from all over the world, from Singapore to India to Australia to the UK to various European nationalities also. So we have a really diverse and highly skilled team that we're very proud of. We've been in Singapore for a long time now, coming up here from Sydney in the early 2000s. And we are now one of the longest standing privately owned financial advisory firms in Asia, which is certainly something to be very proud of in this dynamic landscape. In terms of the areas of advice that we cover, obviously tonight is not about us. I do want to make sure that we spend the time focusing on what you're all here to hear throughout this session, but just very briefly on the areas that we cover. As I said, we're privately owned, so we're not tied to any bank or insurance product, and therefore can give a diverse range of advice, whether it be investments, retirement planning, insurances, how do you move to a different country in a tax efficient manner, how do you repatriate money to Australia, all of these common questions that a lot of our expat clients face, we can certainly assist. But as I said, enough about us. We're absolutely delighted and blessed to have David with us. David is the technical expert and certainly an expert in all things tax planning, estate planning, mobility. If you want to move your money in an efficient and tax efficient manner, David is certainly a very valuable resource, and certainly a resource we're very delighted to have access to. David is with Quilter, one of the global insurance platforms that we utilize for a number of our clients, and absolutely delighted to have him join us for the session. David's got a lot to get through, so as I said, plenty of time for questions. They are being monitored. But on that note, David, I'll hand over to you to kick us off.
Thanks, Jared, and good afternoon to you all. As Jared said, my name is Dave Denton, and I'm very pleased to have gone through my 30th year in working in the international financial services industry. Most of what I do is working with those clients and advisors who are looking at multiple countries. They've moved from country A to country B and may move on to country C, or alternatively, they're investing in country D, or their family and relatives are in countries X, Y, and Z. Global mobility, when it comes to financial planning, means things are incredibly complicated today. And there's a huge temptation when we live in a country such as Singapore to believe that we simply don't pay taxes. So much of the discussion from today is born out of the following suggestion, that what we have to spend either now, in our retirement, or pass on to our loved ones thereafter, it's not just our savings and investments and pensions plus or minus growth. It's our savings, investments, pensions, plus or minus growth after taxation. And taxation can sometimes be a surprise to us, because today we don't expect to pay it on our investments, but tomorrow there'll be another situation. So pretty much what I want to do today is really share some ideas and thoughts in terms of what we need to look out for. We can't cover everything today, but we can highlight some of the difficulties and some of the opportunities. So very briefly, who are Quilter International if it's not a brand you're familiar with? Quilter International work on behalf of 90,000 clients, and we've operated in the cross-border space now for over 35 years. We do business in 40 countries, but because of global mobility over that period of time, we now have clients in more than 100 countries worldwide. I've been in the business for 21 years, and our parent, Quilter PLC, is London-based, and they represent a business that's now in its 250th year, and they're a founding member of the London Stock Exchange. So a huge amount of experience to draw on, some of which I'll be sharing today. Now, I fundamentally believe that knowledge allows us to make better decisions, and the world is a very complex one. Every country works in its own way. Even within the European Union, there is no tax harmony or synergy, and there's certainly no legal synergy. And when we're in a cross-border situation, we need to understand both the tax liabilities and legal aspects to what we want to undertake or plan to do. Now, just thinking of the UK alone, and I'm picking on that because that's the country where I'm based right now, we have the second longest tax code in the world. And it's not like a silver medal in the Olympics. It's not a proud boast, because this makes things difficult. That's 17,000 pages of tax legislation. And in terms of how you would read that or see it in terms of size, a better representation is it's more than 12 times the size of the King James Bible, both Old and New Testament. And there's a lot in there that needs to be debunked, plus that equivalent in Singapore or Australia or in any of the other countries that you may be involved with during your lifetime of saving, investment and passing on wealth. So we're trying to debunk some of the complex aspects of what we're subject to. And there's so much we could talk about, but we're going to concentrate on just a few very small areas. And these are those we're going to look at as I talk for approximately the next 45 minutes, and there'll be a little bit of time for questions. I'm going to hopefully focus on one area that for, inverted commas, Brits abroad is probably one of the least understood, that can be highly important in terms of the way one should think about investing their wealth. And when I mean investing your wealth, I'm not saying whether you should buy Amazon shares, it's how you should own your Amazon shares. So this isn't a discussion about what makes your wealth grow the fastest. It's to do with how you keep more of it for longer. So we're going to talk about domicile and why it's important, and we'll overlay that to other countries, including Singapore and Australia. I also want to talk about one of the fascinations that I see when I visit Singapore, and that's the love of UK residential property. Because if you're not up to date when it comes to property taxation, you'll be very wide of the mark when it comes to your net return after taxation. Now, if you invest, it's almost impossible not to own a little bit of the US PLC. And that's because the US stock market in some periods of its history has represented more than 50% of the world market. But owning US wealth can provide you with tax liabilities that are otherwise unexpected. So let's look at those potential liabilities and see how we can solve them. And then we're going to think about insurance as an investment. As a financial services business, as already indicated, working in 40 countries, more often than not, we advocate the use of insurance-based investment solutions. And when I use the word insurance, I don't mean life assurance in the critical way we're looking for a sum of money to pay out upon our death. I'm talking about a format within which one can own a very wide range of investments, a little bit like a trading platform, but written under insurance rules. Because in countries such as the UK and Australia, insurance platforms like this have really significant advantages that we're going to look at in terms of tax. But also they can buddy up very nicely, and also with the use of a trust can give some other long-lasting important financial planning effects. So I think you'd agree there's a lot to talk about there. And though I don't want to start off with an apology, I'm going to say this is going to be complicated. And there's always a battle as a presenter. Do I tell people everything and confuse them, or do I hold back and give them the most important aspects? And what that eventually means, as Jared's already indicated, is that the most important aspect of this is if this resonates, that you take appropriate advice that's relevant to your individual situation. So I'm going to start off with a discussion on the subject of domicile. As I've travelled very extensively, as until March last year, like so many of us, the subject of domicile comes up very frequently. And that's because for most people, it's so poorly understood. And that's really because in the UK context, it's not part of any formal written legislation. And that's because the UK, like a number of other countries around the world, is a common law country. And common law countries' legislation is built up by judges determining outcomes over a period of time. So it's what the courts determine, and it's not always prescribed in a written down way that people would like to see. So it's not a day count test, and one's domicile is different from your residence, your nationality, or citizenship, or your passport. But understanding what it is, how it can change, and the impact on tax, especially from a UK construct, is vitally important. And that's what I'm going to do over the next few slides. Now, many people, when they understand domicile, would hope that they've lost it or could choose to lose it. And it's not a choice that's an easy one, and it's actually not a choice for many people at all, because it comes down to your actions and your intentions, as you'll see as we move through the slides. Now, one's origin really comes from one's parents. And from a UK perspective, everyone has one of 5 different types of origin, but we all start with the same domicile of origin. And a domicile of origin is the domicile that we acquire from one of our parents on the day that we're born. And if on the day that we're born, our parents are married, we take our father's domicile. But if that's not the case, we take our mother's domicile. And that will stay with us no matter where we live in the world, unless a certain set of things happen. And many people's perception is that when one moves country, just like your tax residency, your domicile will change too. And that's not necessarily the case. Now, from a UK point of view, your tax residency is very finely defined in law, and that's by the statutory residence test of 2013. And if we're thinking about this from Australia perspective, I'm sure many have been reading in the press how legislation is changing to make this more defined and prescriptive, but also it will mean that many people who are still physically outside of Australia could also be categorized as Australian from a tax perspective. And that's true with so many countries. You might not be physically present, but you still could be considered a tax resident of that country. And what that definitively means is that when you do anything from an investment perspective, before you do anything, you need to know where you're a tax resident so you can know the tax outcome of the action that you undertake. And that can be buying an asset, or more importantly, selling an asset, or it can mean transferring it to somebody else, or transferring it to another structure such as a trust. Now, there's so much within that, we're going to scratch the surface, but we are going to focus on it briefly from a UK point of view, because many British people overseas are of the view that they lose their UK domicile, and that has a good implication from a UK inheritance tax perspective. Now, here's the rub. If you are UK domicile, then upon your demise, the only certainty in life is that will pass away, is that your worldwide estate is subject to UK inheritance tax. And if you are no longer UK domicile, or never had a UK domicile, then your liability to UK inheritance tax is only on your UK Situs assets. In other words, the wealth that is legally defined to be based in England, Wales, Scotland, or Northern Ireland. Now, from an Australian point of view, the various states removed the equivalent of inheritance tax from the statute books a number of years ago. So from an Australian's perspective, you may think, well, this doesn't apply to me. But you may be Australian and you may be living in Singapore or not. And Singapore, of course, removed inheritance tax from the statute books like Hong Kong did in the mid-noughties. So you may be thinking to yourself, I'm in Singapore, I'm from Australia, and inheritance tax in other countries never applies to me. But if you invest your wealth outside your home location, the way you invest it will determine if you have a liability. So perhaps you could have a liability in the UK or in the US simply by owning US or UK wealth. And it's very common that investors, for example, from Asia will buy, for example, UK residential property. And we'll talk about this a little bit more as we move through the presentation, with the expectation that because they don't live in the UK, they just own some property there, then they're not UK domiciled, there's no UK inheritance tax liability. But unfortunately, that is the case, there will be. subject to reliefs and exemptions. So let's think for a moment. Maybe you've come from the UK, or you had a UK domicile of origin, you've moved overseas, you've been there for a long period of time, you're of the belief you have no connections with the UK, you potentially have no tax liability in the UK. And that's actually quite a distant thought for some people. It's a distant thought because they just simply make assumptions. And one of the most difficult aspects of me in financial planning is we all make assumptions and we have all certain beliefs. Some of them are perpetuated by the press or looking at outdated articles through Google. But in reality, we shouldn't assume, we need to take advice, and we need to review regularly. So if you've left the UK and you think to yourself, am I UK domiciled or not? What do you need to contemplate? Now, I'm going to make a suggestion that there are broadly 4 tests, albeit they're not actually formalized tests. And the 4 tests of them, 2 are objective and 2 are subjective. And I reckon you have to pass all 4 tests so that your domicile has changed, so that as someone who has hopefully lost their UK domicile, you're no longer subject to that horrible swinging 40% tax on your demise. Now, the objective tests are that you must establish residency overseas and you must acquire a domicile or the equivalent in that country that you're living in. In other words, you must have the ability to remain in that country for an indefinite period. And it's for that reason that if you move to countries, for example, in the Middle East, where your right to remain is only linked to a limited ability to stay there for the purpose of employment, it's actually implausible that you might be able to meet the second aspect of the objective test. So if you've left the UK, where you're living today, do you have the unlimited right to remain there? If you don't, it's very difficult to argue the point that you've made the objective tests work to your favour. Now, surely there can't be subjective tests when it comes to tax, but in reality, effectively, there are, because we need to sever our links with the UK. Now, if we look at the semi-official tax guide in the UK represented by Tolley's, then they indicate there are a whole series of possible links. They also go on to say there's no definitive list of links, but one needs to sever links with the UK because ultimately we must have an intention to remain in our new home permanently or indefinitely. And all these aspects come into play. Now, until a number of years ago, and I think it was probably 2012, one could apply to UK tax authorities, HMRC, and you could ask for a provisional ruling. What is my domicile? And after a significant interrogation of your situation and your intentions, they'll give you a provisional ruling. But that provisional ruling was a provisional ruling only on the date that information was provided to HMRC. And any small thing could have changed after that provisional ruling, and your domicile could have effectively changed. So this is quite tricky. Now, what you'll notice from these steps is that there's no fixed time determinant. So to say I've left the UK 20 years ago simply does not indicate my domicile has changed from the UK. And also, if I perhaps have moved to another country, potentially, for example, to Australia, and I've effectively, inverted commas, passed all these tests, I might think to myself, I've lost my UK domicile of origin, I've acquired a similar status in Australia. But if I have an intention at some point in time to move, and it might not be to the UK, it could be to move perhaps to Malaysia, Thailand, or Singapore. That mere intention not to remain in the new country I've acquired as my new home would actually mean that I haven't lost my UK domicile of origin. So it is a matter of intention as well as your action and the other things that you've seen on these slides. So if you are a Brit abroad, excuse the comment or phrase that I use, how do I think about this in terms of how the revenue look at it? Well, as I draw to my conclusion on looking at domicile from a UK perspective, I just want to give you 3 paragraphs from an important internal practice manual from HMRC in the UK. And this is the Residence, Domicile and Remittance Manual, paragraphs from subsection 23030. And these are the sorts of things those people at HMRC are going to be looking at if you, or more likely, your executors upon your death are trying to argue the fact that your domicile has changed. And therefore you've removed yourself from the 40% liability of UK inheritance tax. And you're probably reading ahead of me. And you can see that the first pointer is that changing domicile is not an easy thing to do. It's considered onerous with serious steps requiring unequivocal evidence. Now, you can't prove this in your lifetime. It's only relevant when you pass away. So that evidence needs to be held and stored by the right people who can argue it posthumously. So many Brits abroad will go to the grave not knowing how their domicile will be determined when they pass away. And that could mean if you think you may have retained your UK domicile, then you should plan appropriately. And there are a number of appropriate planning steps that a UK domicile can undertake through careful financial planning to accept potentially their UK domicile, but remove inheritance tax by courtesy of their investment actions. And that's what GFC could guide you through to help you determine. So we've seen here that the steps you need to undertake and the balance of proof is really significant. And the sort of things that you could be asked in your lifetime when this would have been determined during your lifetime, but now will be determined upon your death. HMRC will be asking, for example, the religious, cultural and social connections in the country that you have your new domicile, including the degree of religious observation, participation in society, and ability to really be there by speaking, reading and writing the relevant languages. So you can see there's a build-up of a picture of how difficult this is to achieve and no certainty in your lifetime. And the final comment I'd like to show you is the sorts of things that could be asked. And the manual itself has approximately 40 different questions that could be asked, with the caveat at the end, these questions aren't definitive. And the legal profession in the UK is constantly frustrated that the list of questions can be absolutely endless and include things, for example, such as what plans have been made for the future, what contingencies have been taken into account, what would cause a change of residence, provisions for the future, and then what has the individual actually done that provides evidence to the answers to these questions. So the burden of proof is really very significant. And for that reason, many people from overseas, particularly in Singapore, because they're unlikely to actually retire and remain there for the rest of their lives, will have retained their domicile of origin in the UK. So from an Australian point of view, this is generally less significant because inheritance tax per se, or estate duty in Australia, is no longer on the statute books. It's not to say it will remain that way. Some countries, especially in Asia, have actually added inheritance tax back in because of what they've seen is the threat to the public purse in recent years. And a very recent report earlier this year by the OECD, the Organization for Economic Cooperation and Development, which represents more than half of the countries around the world, a detailed report advocated because the financial pressures imposed upon many countries by COVID-19, a good way to raise taxes and redistribute wealth in a way that's needed would be to review and implement or potentially increase inheritance taxes. So quite an interesting thought that sits behind this. If you think it's bad today, who knows, it could be tougher in the future. And that's the value of inheritance tax planning, to work out what's possible today, to work out what the law allows, and then undertake your options as appropriate. So I'm going to slow down for just a moment because I'm going to move on to arguably an even more complex area. The slide I have here should be of interest to those people who like the idea of owning UK residential property. Now, over the 9 years between 2012 and 2020, there have been a whole series of fundamental changes to property ownership in the UK. And many of these have gone completely unnoticed by owners abroad, who probably won't have their finger on the pulse of property ownership requirements in the UK, but as a foreign buyer may be more interested with the comfort and homely feel of owning a tangible fixed bricks and mortar asset in a country where laws are strict and political risk is minimal. And that's why I think lots of Asians like the look and feel of UK property. And not to mention that for the majority of years in the past 30, there have been positive years in terms of capital appreciation. But I, for one, in this market, having been here for 30 years, can remember two situations in particular where there have been significant corrections. But if we own property to live in, we can accept much of this. If we own property as an investment, we need to be mindful about some of these changes. So this isn't a session on UK residential property taxation changes. I just want to highlight a few key things that might have escaped people that could have become more appropriate if they've purchased, or may only become more appropriate or important when they sell, because property taxes come about when you purchase or when you sell. Normally when you purchase, you're thinking about stamp duty, land tax, and normally when you're sell, you're thinking about capital gains taxes. So the point of this slide is really to say, if you're interested in UK property and you already own it and you live outside the UK, take advice before you sell that property. And if you're going to buy property in the UK, take advice before you do so. Because there are ways you can sell and there are ways you can buy. And sometimes the way that you do it will impact the rate of stamp duty that will apply, and also the rate of capital gains tax that will apply, and whether it will be in the UK or otherwise. I just want to highlight just a few of these key aspects within this table. And for people who once owned property in the UK or still own it today, but now live abroad, I want to highlight what is perhaps the most relevant change. Now, it might surprise you to know that if you're not a UK tax resident, then until 2015, you didn't pay capital gains tax on capital gains in the UK. But from that date, non-residents pay capital gains tax on residential property. Now, that can be a challenge for a lot of people. Some people still think you don't pay that tax as a non-resident. Some people think, but I'm living in a country where there's no personal tax on overseas wealth, so why would I pay it? Well, it's not chargeable in Singapore, but it's certainly chargeable in the UK if there's a gain. Now, what's important is the value of the gain is chargeable up until the change of legislation. But remarkably, as someone who this tax applies to, when we sell a UK property, we have a choice of how the calculation of the gain is made. Now, one option for choice is to know the value of your property on the 6th of April 2015, and very few people will know that. So what one would normally do is say, how long have I owned the property before and after the relevant date? What did I buy the property for and what did I sell it for? I look at the total value of the gain over the full period of time, and I apportion the gain according to the amount of time that I've lived in the UK or had reliefs available to me. And that's how the liability is normally worked out. Now, some people say, well, if I return to the UK, surely I can requalify that as my principal private residence. And once again, rules were changed in 2015 that make it much more difficult for a non-resident, even returning to the UK, for their property to qualify for principal private residence relief. And for many people overseas, trying to claim it for a year that you're abroad, you'd actually have to be physically in the UK for 90 days. Which could mean you're actually a tax resident. So there are lots of traps, but also some potential opportunities by understanding the law that applies to this. Another key area for owners of UK property was the change such that from April 2017, foreign owners of UK residential property previously did sue through an offshore company, and that offshore company removed inheritance tax on the UK asset that was UK property. And that was removed on the 6th of April 2017. And effectively, it was retroactive. And I say that slightly tongue-in-cheek with a slight smile on my face, because retroactive is retrospective in my mind, but can arguably say that's not the case. So what retroactive means is the law only came in 2017, but it catches also properties that were held in offshore companies to remove inheritance tax that were created that way before that date. So very many people who were well advised before that date did the right thing, owned their UK property through an offshore company, and it worked for all the right reasons until that date. And there are many people today who own their UK property through an offshore company for which they pay a significant fee for no benefit whatsoever. Now, that's a very short story on a very complex area. And I'm not advocating that company is dissolved, but what I am advocating is an understanding of what needs to be done to minimize risk and reduce exposure to tax is wholly appropriate. In terms of purchasing property, one might be familiar that back in 2016, there was an additional rate of stamp duty land tax. So stamp duty on the purchase of a property typically can be up to 12% in the UK, unless you buy it through a company where you're disincentivized to do so by paying 15% stamp duty if the purchase price is more than £500,000. But from now on, if you own a second property or buy a second property, you pay an extra 3% stamp duty. But it's even more complex than it sounds. It's not someone from the UK who already owns a UK property who buys a second UK property who pays the additional 3% on the second property. I'll give you another example. Maybe you're an Australian couple and you could be living in Australia or Singapore. One of you individually owns a property and that property isn't in the UK. The other partner then purchases a property in the UK, and courtesy of being married to somebody who owns a property, albeit not in the UK, will normally be subject on that property purchase in the UK to an additional 3% stamp duty. And now introduces a suggestion in 2019, but actually implemented from April this year of 2021, there's a further 2% stamp duty land tax surcharge for non-resident purchases. So if you're a non-resident purchaser of UK residential property and it's not your first property, then that's an extra 5% on top of a rate that's already up as far as 12%. So lots of things that come into the mix, and that's without looking at these other very significant fundamental changes that challenges the way we need to think about property as an investment. Now, not to say that it isn't a good investment, but for most people, it's the post-tax position that's important and not the pure and obvious growth when we sell. So ladies and gentlemen, I've already covered a huge amount of ground, and I'm going to dodge now onto a completely different area. I'm actually going to think about investing in US stocks, shares, and other wealth. And that's because so many of us do this. When I first joined the industry 30 years ago, in my travels, it was absolutely clear to me that investors around the world had a strong home country bias. So if you came from Asia, you probably never entertained buying stocks from the West. Yet today, diversification, investing outside our home country, is something that's a substantial part of our thought process. Now, I already indicated in the introduction that owning US stock is something that nearly all of us do. And if we think about it, of the top 10 biggest companies in the world, 8 of them are purely American companies. Apple, Amazon, Microsoft, Google, Facebook, Netflix, all these businesses are absolutely huge, and some in isolation are bigger than the net worth of smaller countries around the world. So the chances are we own US stock. Now, one of the fundamental interesting aspects of owning US stock is that actually you can have an estate duty liability when you pass away for the privilege of doing so. Yet in the US, few people talk about estate duty. And that's because if you're a US domicile, citizen, green card holder, or meet the substantial presence test, well, you would pay US estate duty on your worldwide wealth, but with a very large exemption. And if you are married, your exemption as that couple would be over $23 million. So that would apply to very few people. However, the fly in the ointment, if I can call it that, is that if we own US wealth, but we're anyone else, so we're not the US domicile or citizen, etc., the amount of wealth we can own that is considered US Situs before we're subject to US estate duties is no more than $60,000 US. And I think that's a shock to a lot of people. And increasingly, the US authorities have really been enforcing this. So it's important to understand how our wealth is owned. Absolutely, we should own some US assets as part of a balanced portfolio if that's what your advisor suggests. But how you own it will fundamentally determine how it will be taxed before it's passed on to your loved ones. So I need to debunk the word US Situs. So if you're one of those people today who's from Australia or from Singapore and you're thinking to own US Situs assets, what is a US Situs asset? Now, a US Situs asset is in fact an asset which is legally located in the US. And here's an indication what those Situs assets might be considered to be. So if I own a US share in a public traded company, it's a UK Situs asset. But I want to point out the words below that also says, if I own that stock through an offshore nominee, for example, I might own my US stock, but through an entity that's perhaps a trading platform in a tax-free environment, maybe Luxembourg or Channel Islands or Singapore, then that liability to US estate duty doesn't go away because my wealth is held that way. Now, insurance-based investments, and we'll talk about this a little bit more in a few moments' time, effectively mean you link the value of your wealth to the companies that you choose, but from an estate duty perspective, you don't own those assets. So there are always ways to approach one's ownership of wealth that through early planning can mitigate potential liabilities that can otherwise be very significant. So please make no mistake, if you're a Singaporean in Singapore and you're owning US stock, how you own it will determine how much of it is passed on to your loved ones when you pass away. Now, the US has a modest number of estate duty double tax allowance, double taxation agreements with other countries. And there are only, in fact, 16. So the chances are, in most instances, if you're owning US wealth, there is this potential liability according to how that wealth is owned. So let me move on very briefly now, and I'm going to talk about something in a slightly different context. I want to start talking about, from personal investment perspective, how we might be expected to be taxed. And I'm going to do this by almost suggesting how every country in the world is taxed. And I'm going to suggest to you there are almost 200 sovereign states in the world. And from the purpose of personal taxation, and therefore also how your investments are taxed, you can break those countries down into 4 separate types of taxation. And I'd like to explain these because this will then help you consider how you might want to invest to minimize your personal exposure according to where you live today, where you live tomorrow, or who will inherit your wealth. So there's a small number of countries in the top left where there's no personal taxation. So for example, if you live in the UAE, there's no personal taxation. There's no personal taxation in the UAE. If you have wealth in another country, you may be liable to taxation in that other country. It's not just your tax residency that determines your tax liability, it's also where your wealth is situated and how it's housed in that location. Now, there are 38 countries around the world that work on what's called a territorial basis. And there used to be lots of countries that were territorial, but over the years, many more countries have changed their basis of taxation to a residency-based situation. And that's because the world is becoming a smaller place. People move more and their wealth is outside their home country. So if you live in a country with this territorial-based taxation, that means that your investment income and investment gains made outside that country that you live in, even if remitted, in other words, brought into the country that you live in, isn't chargeable to tax there. So if I live in Singapore, for example, and I have investment gains in another country, and I encash those assets and I make those gains and I bring those gains into that country, I'm not liable to tax there. My liability to tax is on my domestic earned income in most instances of a territorial or a source-based location. And that's quite nice from an investment point of view, because on the face of it, so long as I don't invest in my home country and I invest overseas, then I shouldn't pay tax on my investable wealth. But most countries, including the UK and Australia, have a different basis, and it's the next most challenging basis. And it says, if I'm a tax resident, for example, of Australia or of the UK, then any investment income and gains from overseas, even if I don't bring those investment and gains, income and gains into that country, is likely to be chargeable to tax. So the fact that gains occur overseas, even if I don't bring it home, can make those gains chargeable to tax where I live, for example, in the UK or Australia. In fact, over 130 countries around the world. And there are 2 countries then that have an even more challenging environment if you're an investor. And one is very well known, it's the USA. The other is a little bit more like a pub quiz question. And that is that, for example, if I'm a citizen of the US, even though I don't live in the US now, even though I haven't lived there for 30 years, even though my wealth isn't in the US and the profits aren't remitted there, I have a reporting obligation in the US and potentially an obligation to pay tax there. And of course, it feels even unfairer because you might be a US citizen having never actually lived there at all. There are plenty of examples of people who are considered accidental Americans by birth. So what does that mean from a functional planning point of view from your investments? So many of you listening in today will be residents in Singapore, but many of you will have come from countries outside of Singapore and enjoying the tax aspects of living in Singapore with low personal rates of tax on domestic earned income and probably no tax on your investments. But the chances are of you remaining there in your retirement and beyond are actually quite unlikely. It's difficult to do so, the costs are very high, and the statistics say that's probably not what realistically happens. And many people who come from the UK will go back there, or if you come from Australia, you'll go back there too. And if you come from the UK and you don't go back to the UK, but you move, for example, to Australia, you're moving into another environment that's very much like the UK. And similarly, if you move from Australia to Singapore and then out to another location. So how does how you home your investments determine your long-term liability to tax on your investments, and not just in that country that you're in for that intermediate period of time that's likely to be Singapore? Well, the fact is the right investment medium can have a very big difference. And I'm going to introduce you now to using insurance as an investment platform for one's investable wealth. Because as a business that advocates this to financial advisors, for them to consider their clients in many countries around the world, there are some really material benefits in doing so. And I want to share with you briefly what those benefits might look like in cross-border situations with particular reference to the UK and Australia. And I want to share with you the benefits of insurance as a trading platform, firstly comparing it to a more conventional trading platform that isn't insurance-based, and then looking at the incremental benefits available from an insurance-based trading platform. Now, as an investor, as well as guidance as how our wealth is invested to optimize our returns and minimize our risks, we want that wealth to be held somewhere that's functionally easy. And trading platforms are exactly that. Consolidated viewing of your wealth, easy to manage online, potentially access to a wide range of markets, low trading costs, and multiple currencies. And these things are commonly available through most platforms and most insurance-based trading arrangements known as offshore bonds or insurance bonds. But the incremental benefits from the latter are really very substantial. And they are as follows. If that platform that's an insurance policy is based in the Isle of Man, there's statutory investor protection. That means in the very worst case scenario, if something went wrong, then there's a formal arrangement for monetary protection. Beyond that, there are lots of other aspects that can be quite quirky and complicated, but are still very valuable to consider. And one of them is actually simplified reporting, so that you may link your insurance policy to 3 assets or 12 assets or 25 assets. But from a reporting point of view, you only own one single asset, and that's the insurance policy that goes in aggregate up or down in value. And according to where you live in the future, that can be incredibly valuable. It can also be helpful from a discharge of knowledge, because through something called the Common Reporting Standards, everything that you own individually today is likely to be individually reported from the country that you live in, from where the country your wealth is situated, to the country that you're tax resident. Now, removal of direct ownership, I've really highlighted already for you. And the best example was owning US stock through an insurance bond, or actually owning UK stock through an insurance bond. As an investor, for example, a Singaporean, if I want to own US stock or UK stock, if I do that either directly or a conventional trading platform, that gives me an estate in both those countries that would be subject to inheritance tax in the UK or estate duty when I pass away. And that's actually the same from an Australian resident's point of view too. But if I own that stock through an insurance-based policy, From a tax point of view, I own the policy that's based in the Isle of Man, where there is no estate duty or inheritance tax, and the insurance company on my behalf links that value to the shares in those locations. And that therefore removes that liability to inheritance tax or estate duty. Now, also, when one passes away, we all hope that our wealth can be passed on to our loved ones as simply and effectively and quickly as possible. We'll all be familiar when we're talking about common law countries such as the UK, Australia and Singapore, that the common law typically allows us to write a will where we can determine who will inherit when we pass away, subject to certain restrictions. Now, not having a will is a flaw in anyone's financial plan, but wills still need to be proved, which means they go through a process called probate, which can be slow and delayed. And in most countries, discharging your wealth through a will, though it's ultimately efficient, does mean your wealth and what you own becomes public knowledge. In the UK, for the price of £1.50, one can access anyone's will when they've passed away and therefore see what they owned and who it's been distributed to. With an insurance policy as your investment option, through a policy nomination added to the insurance policy, your wealth can be distributed when you pass away immediately to a loved one without the need for probate and with confidentiality. So that's highly valued. And though we all put off the fact that we know we will all die, having something in place today that doesn't impose on the access to our wealth during our lifetime, but has huge effects at the most telling time of all, can be very, very valuable. And then personal taxation is the last bullet on this slide, and I want to give you a few key examples. If I invest through an insurance bond and it meets certain qualifying criteria, which GFC would be able to discuss with you in detail, should you move to become a tax resident of Australia, according to that policy and how long you've owned it, there may be no personal taxation upon a final encashment. And to keep a slightly longer story simple, after 10 years of ownership of an insurance-based platform, one can normally expect as an Australian tax resident, the profits are not chargeable to tax there. Now that might sound really rather peculiar, but it's very well ingrained in law, and a number of countries are taking explicit advice from the Australian Tax Authority to understand how this may or may not apply. So a hugely valuable feature, because as we know, our investments can grow without the deduction of tax whilst we're in Singapore. But when we move on to our next country, such as Australia, then we're fully beholden to a system where personal taxes can be up to, for example, perhaps 45%. Similarly, should I own an insurance policy as an investment platform and move to the UK? Well, actually, I get full benefit of removing from the taxation on profit an amount of value that reflects the time spent abroad. Now, if that sounds too obvious to you, let me just suggest the following. If I live outside the UK, for example, in Singapore, and I own shares or a mutual fund, directly or on a conventional trading platform, and I move back to the UK and I sell them, I'll pay capital gains tax on any growth going back to inception, and not just relative to the period of time that I've been a UK tax resident. Whereas the insurance vehicle owning similar assets will only be chargeable tax relevant to the proportion of time that I'm a UK tax resident, which can be a very significant advantage for many people. So ladies and gents, lots to think about there. If you're a resident in Singapore, you intend to stay there, and you're thinking about your investments just for today, then lots of things may be available for you in a tax efficient manner. But the reality is the majority of our and GFC's clients are those people who will at a later date be in another location, and liabilities according to that location are fundamentally important in the planning process. Ladies and gents, I can see time is marching on, so I'm going to conclude now with just a couple of slides thinking about trusts in financial planning. And I'm going to be very mindful here because when I joined the industry, I recognized that from time to time, the answer was a trust and what's the problem? And because many years ago, people articulated the trust as the solution to all your financial ills. And actually, trust can be hugely valuable and create significant benefit but I would advocate taking very good advice before one uses a trust. Hugely efficient from two aspects, but only if used appropriately. And one is in estate planning, and other is legacy planning. Now, estate planning is the context of death duties that can apply when you pass away. And there are two types of death duties. One is estate planning or estate tax, and that's a tax on the estate of someone who's deceased. And the other is a true inheritance tax. An inheritance tax is a tax on the person who inherits. And they're two slightly different things, but the net effect to the inheritor is going to be the same. Now, I cannot cover detail today because time prevents that, but trusts, for example, in a UK context can be used to help reduce one's liability to UK inheritance tax. Now, one must bear in mind, you're not flicking a switch and saying, I add an investment to my trust, I now completely removed inheritance tax. If we could do that, we'd do it online every day of the week, no inheritance tax would be payable. It's an area that's complex and does require advice to get it right. And the vehicles that one might look at through your advisor, GFC, would be things such as gift trusts, loan trusts, or discounted gift trusts. And they all give suitable opportunity to begin to, or perhaps wholly, mitigate inheritance tax according to how long you invest for, the amount of access and flexibility that you want on the wealth that you're dealing with. And then lastly, legacy planning, the transfer of your wealth upon your demise to the right people at the right time is what trusts and policy nominations or insurance plans are really effective with. Most people will think about a will, and for almost everybody, a will or more than one will is highly appropriate. And you may need more than one will, because if your wealth is in more than one country, your will may not have jurisdiction in that alternative location. Insurance policies and trusts can help to overcome these problems, including mitigating probate and maintaining confidentiality. Huge areas, significant gains, but also without advice, opportunities to get things wrong. You'll probably think by now this is a very long and complex session. It is, but no apologies. And that really is because that in a cross-border world, there's ample scope for things not to work in the way people anticipate. And my concluding comments really are these. And they're from a gentleman who's better known from being the former chair of the US Senate Finance Committee, one Max Baucus. More recently, the US ambassador to China. He very famously said that tax complexity itself is a kind of tax. And complexity can lead to confusion and inactivity. And the way I often see it is that people assume, don't plan early enough, and if they do, they don't review their situation. And for me, although I can't better the words of Max Baucus, I would suggest from a financial planning point of view, as I'm sure GFC would do as well, don't assume, plan early, and review regularly. Which, ladies and gentlemen, really takes me to the ultimate position that taking advice is something that needs to be done with a regulated entity. We've been in Singapore now for 12 years, Asia for almost 30, and GFC similarly regulated, working in an environment where it's important things are done exactly the right way. So I'd like to, at this point in time, thank you for your attention. I appreciate not all of this is easy to stay with, but GFC, as advisors, are appropriately placed to look at your unique situation to see if you can hold on to more of your wealth for longer. Jared, I'll hand you back. Thank you.
Thank you very much, Dave. Gosh, that's, wow, for anyone who thought that all we did was analyze whether you should sell Apple and buy Tesla, that gives you a little bit of an insight into all of the considerations and research that actually has to take place. So really appreciate everything you've shared tonight. I'm sure there's a lot on the call that do own UK property or were considering UK property, moving to the UK, moving to Australia, wherever it may be. So I think a lot of relevant information for a lot of our clients, not just those who are on the call. So really grateful for your time and expertise. So thank you. Now we've got a few questions here, and I will open up to any others. If anyone else wants to shoot some questions through, please do. We've got the chat box and the Q&A running. So I guess a couple of broad questions to start. So first, I'll generalize this a little bit just to avoid any sort of personal detail coming through. So if somebody's looking, so they're in Singapore at the moment, looking to move to the UK in future, not really sure when. I mean, this is perhaps a tough one to answer. Is there a perfect time to start thinking about how you structure your wealth if you're looking to move to the UK and the UK is going to be home forevermore? You're just not sure when. You know, is that 6 months before? Is it 5 years before? Is it as soon as possible? Is there an answer even to that question?
It's such a good question, and there are different answers according to different forms of wealth. So let me give you an example. If you own UK property and you're going to return to the UK, then I would recommend that you start thinking about what you want to do with that property at least a year before you return to the UK. Because if you don't intend to keep that property, then there can be very substantial advantages by disposing of it before you become UK tax resident. Now, the two things that you don't know are how long it will take you to sell that property, and also very few people know when they'll become UK tax resident. Now, you might say, I'm leaving Singapore today, and I'm going to arrive in the UK on the 1st of August, and therefore I'll be tax resident in the UK from the 1st of August. I've got bad news. For many people, the day you become UK tax resident, maybe the day you arrive, could be the 6th of April just gone, or could be the 6th of April that's coming up. And you need to analyze your actual situation to work out who will become a UK tax resident to optimize your planning. I would also say from an investment point of view, the best time to plan is as soon as you arrive in Singapore, because some insurance vehicles will give you the very best tax outcome in the UK in a very powerful way for the longest possible period you own them as a non-UK resident. I'll leave it at that because that could be the whole subject of another presentation.
No, look, I think that gives people enough guidance. Excellent. Okay, so next question here, an Australian specific one. So forgive me if this is not quite your area of expertise, but I'll ask it anyway. So somebody whilst in Singapore has bought an annuity product, retirement income annuity. For example, they become an Australian tax resident. Is the ATO going to tax that income?
I'm not confident of my answer, Jared. I believe they will do. So I'm going to actually pass that back on to you for a suggestion or further review.
Yeah, look, the answer is yes, but please seek advice from your accountant. Most of the annuity streams in Singapore will be taxable in Australia for Australian tax residents. So for anyone looking to move to Australia, again, you know, today's point, the earlier you start thinking about how you structure the ownership of your assets, the better off you're going to be. So it's not just a case, and it's similar with CPF, you know, the CPF retirement schemes, etc. A lot of these income streams will be taxable in Australia. So hopefully that covers the question there.
Whereas some, of course, Jared, some income streams won't be taxable if they're purchased early enough.
Yes, yes, very good point. Okay, next question. Again, this is a bit of a broad one, but let me throw it at you anyway. So specific reference to US shares and the Australian tax, the Australian 10-year rule. And perhaps it's better to break this question into two. So the question is very simply, what if the rules change? What if the estate tax limits change with the US? How do you plan for a potential change? Should you plan for a potential change? Is there any real downside if the rules do change?
It's in financial planning, we always labour under the threat of change. And although we don't know what's going to happen in the future, sometimes the direction of travel is known. Let me give you an example. The US estates duty limit for US citizens, £11.7 million per person. That was doubled 3 years ago to Donald Trump's Tax Cuts and Jobs Act. It was doubled but it's going to halve again, I think, in 2026. So there's always more mischief than you would imagine. We can actually only plan for the rules today or how they're announced for the future. In reality, we would love to be able to accommodate any unforeseen consequence, but that is the point of my mantra. Don't assume, plan early, and review regularly, because that will give you the best opportunity to take evasive action if you have to.
Excellent answer. Okay, so our next question here, I guess sort of frames this in a different manner. So somebody who is living in Singapore, Singapore resident or Singapore citizen, looking at how they plan for their Singapore-based assets if their beneficiaries are residents of the United States or citizens of the US. What should they be thinking about? Are there things they can think about? Are there structures they can use?
Yeah, so if you receive benefit in the US, US estate duty is on the donor and not the recipient. So the good thing there is there's unlikely to be estate duty or inheritance taxes either in Singapore or the US unless any of the rules change. But it can still mean there can be personal tax liability on profit in some instances on what's inherited, but not on the value of that estate. That requires a very detailed analysis of the exact situation, but there is planning that potentially can be done, but it requires personalised advice.
Wonderful. Hopefully that one covers that for you, but please do let me know if there's anything that wasn't quite covered there. I think we may be at the end of our questions. I can't see any more that we haven't quite covered there. So I'm mindful we're at just shy of 20 to 7 here in Singapore. So we might wrap up there. If no one has any other questions, we can wrap up. We will send out a copy of the recording of the webinar. We'll be publishing this across our social channels also. So you will have access to this information. If anybody has any other questions that we haven't covered, if anyone would like to have a one-on-one with an advisor with GFC, please do reach out, let us know. If there's anything you'd like us to cover for future webinars also, please do let us know. But otherwise, thank you so much for joining us. Dave, a huge thank you for your time. It's been hugely valuable tonight, and I think everyone on the call would agree. It's been an excellent session. Really, really appreciate your time. But on that note, thank you very much for joining us, and have a great evening or have a great day if you're elsewhere in the world. But thank you very much.
Thank you, Jared, and thank you all. Goodbye now.